This example is something that I think is timely. All right, we've got people in situations where you need to understand, and with gain, I've got that slide. If you get the slide deck, you're going to see it. Phantom gains. Phantom gains are when debt exceeds basis. Okay, so in a foreclosure on a primary residence, you've got some tax relief. Income properties, you don't. So what happens is in a foreclosure, if the debt exceeds the basis, your debt is treated as a sales price, you're going to be taxed gain on that spread. That's an ugly deal. So think about this. You lost the property foreclosure, you lost all the money in it, and now you're getting hit with up to a 40% tax consequence for the pleasure of doing that. So what happened is in this situation, we would get involved, and we did a number of these during the last crash. And I sort of have been watching for them. This time we haven't had it, fortunately, and hopefully as loans are starting to come due on bigger properties, that people are going to be able to either sell them or get them refied where they don't have problems, because I'm seeing situations where we're having capital calls to get a refi done. I had a call the other day, gentleman called up, says, look, I'm going to be selling in the spring, my loan's coming due, my apartment building's currently got a 3.8% loan on it, now I'm looking at 6%. I can't deal with this property at that level, so I'm going to be selling the thing. So that, keep an eye on that stuff, because I think opportunity is going to be coming up. But in this situation, it's a pretty easy question to answer, because what the taxpayer has to look at is say, okay, gee, I can lose the property to the foreclosure, triggering phantom gain and pay 40% tax, or I can do an exchange. And it's really sort of funny. You're going, well, David, how can I do an exchange? There's no money coming out of it. What we're doing is we're isolating the taxpayer from actual or constructive receipt of debt relief in this situation. And what we were doing in this time period is we were taking the exchanges, assigning the membership interest in the old property to us pre-foreclosure. When it's foreclosed, it was ours, and they move forward through the exchange. And what we'd be buying them a lot of times was what would be called, for example, Inland Private Capital had a zero coupon, 80% loan to value DST offering that these people would then exchange into. So they had a choice. I'm going to come out of pocket 40% and get nothing, or I'm going to come out of pocket half as much and get a DST. Now that DST wasn't going to pay out monthly, but over the hold of 5 to 7 years, you've got equity building up in there, and at the end of the 5 to 7 year time, now you've got a situation where you've got some equity, and you're going to be able to move forward with the thing. So, do you want to pay twice as much for nothing, or pay half as much and get something? And like I said, for people that are aware of this situation, it's a great opportunity. If you're not aware of it, like I said, you don't know what you don't know.
Thank you.